We're going to continue our look at the individual components of aggregate demand. So the last video looked at C. We're now going to move on and we're going to look at this I component of aggregate demand, which as you might recall from a previous video, refers to the level of investment within the economy. Now, before we actually kind of get started and look at the things which influence this, there are a few things that we need to make clear about what this investment actually refers to, because it's one of those terms that if you don't use it properly, it can cause you some problems. Now, if we think about it in terms of what investment is officially referred to in the UK accounts, it is the gross fixed capital formation. Now, it sounds quite technical, but that does kind of include a few things that we need to think about here. Firstly, let's deal with this capital formation at the end of it. Now, what this means is that we are looking at investment which generates capital within the economy. By capital, here we're talking about physical capital. So, in order for it to be considered investment, in order for it to be counted in that I component, it has to be something that generates physical capital, something like a building or a piece of machinery or something like that. It has to generate some physical asset. Importantly, this means that something like investment in shares, which is a phrase that you'll hear quite frequently, that's not considered in I as far as an economist is concerned, because when you're buying a share, you're not investing that money directly into the creation of capital. So that wouldn't be considered I. The other bit that we need to think about here is this idea of what gross means. Now, the alternative to gross is net. And when we're talking about investment, gross investment, which is what we're talking about here, is the total amount which is spent on the creation of fixed capital. So gross is the total amount that is spent on fixed capital within the economy. Net means that we will deduct from that, essentially, the cost of repairing the stuff that was already there. So when we're talking about gross investment, we're talking about things like repairing roads as well as the construction of new roads. If we're talking about the net level of investment, then we are talking about only the creation of new capital. We're deducting the cost of repairing the stuff that was there before. The degradation of capital over time is referred to as depreciation. So some proportion of investment must go towards countering those effects, essentially by repairing the stuff that was there. So the distinction that we've got here is gross is all fixed capital spending, which means new and repair, and net is only new fixed capital spending. So when we are thinking about the I component, we are thinking about this gross figure. The net one is going to be very important when we think about development economics in the second year. One of the big challenges of developing economies is that they may not have enough investment finance available just to repair what they've got as it is. So that means that they have no net investment taking place within the economy. But now that we've kind of clarified those terms a little bit, let's move on and let's think about the factors which will influence the level of investment within an economy. So when we think about the factors influencing investment, it's a little bit like consumption, really. There are separate ones that you need to be aware of, although a lot of them do overlap and have quite a few similarities to them. But let's work our way through and think about the main things that are going to influence the level of investment within an economy. Now, the first one that we're going to think about is the rate of interest within the economy. Now, you may well remember from our previous video that that the interest rate is the cost of borrowing. Now, how does that influence investment? Well, a lot of firms borrow money in order to be able to invest. It's quite common for firms to borrow the initial capital, because hopefully by investing it, they will be able to generate those returns in the future that will enable them to be able to repay. So let's think about a scenario then where the rate of interest was, let's say, 4% and has now risen to 6%. So the rate of interest rises from 4% to 6%. So what does that mean for firms who are wanting to invest? Well, previously, it would have been the case that any investment project that was going to generate a return of more than 4% would have been profitable. So long as the project generated more than 4%, so let's say it generated 5% annual return, it would have been profitable to do that, because it would have paid all of the interest and it would have allowed a little bit of profit for the business. But now that project, let's say a 5% project, is no longer profitable at 6% interest. So when the interest rate rises from 4 to 6, it means that those projects with a return in between those values cease to become profitable, and therefore the firms considering those projects are probably not going to undertake them. So interest rates have a really important impact on the amount of investment that firms are going to make. Now, of course, the alternative is that they don't use borrowed money to be able to invest. They use their own profits. So the profit level of the business is another important determinant of the level of investment within the economy. So the things that we may have to think about here are, for instance, cost of raw materials. We may have to think about labour costs and things like that. So changes in the costs of production may well mean that that businesses become more or less profitable. And obviously, if a business is more profitable, generating higher levels of profits, they are more likely to increase investment. Now, linking to that is a very important factor when it comes to the level of investment within the economy, which is expectations and confidence. Now, expectations are really important because of the nature of investment. Investment is spending on capital now to generate, hopefully, profits and returns in the future. So those expectations are really important. And if business managers, the individuals who are making these decisions, are confident in the future and the future demand for their products and so on, then they are much more likely to invest. If they are uncertain about future demand, then they may well make more, I suppose, conservative decisions. They may well decide that actually it's not worth undertaking those projects. So expectations and confidence by themselves are very important. These were also an important part of a concept known as animal spirits, which was put forward by Keynes. We already come across Keynes, but he had this idea of animal spirits, which is essentially that the economy and particularly investment is driven by animal spirits and this inbuilt confidence, or lack of, I suppose, amongst the managers within businesses who are making these investment decisions. So expectations and confidence is another important aspect of it. Tied into that is the level of economic growth. So economic growth, as we've seen in earlier videos, economic growth is an increase in GDP, and if the economy is growing, then it's quite likely that firms are going to want to invest more, firstly to support that growth, to support that higher level of consumption, but also, so support high levels of consumption, well, I suppose actually of of the AD, but also because economic growth tends to breed confidence. So when the economy is growing quickly, businesses will hopefully become more confident that the future of their company is more secure, and as a result of that, they are more likely to invest in projects. This concept where economic growth drives higher levels of investment, so economic growth leading to investment, is known as the Accelerator Effect. We will come back to that later on, but the Accelerator Effect is when economic growth drives higher levels of investment. So if we just move this down a little bit, we can just deal with the last ones. So related to economic growth, you've seen almost as I've gone through this, every one has been related to something previous. We've got the level of activity in the world economy, because this will affect exports. So if there are high levels of economic growth overseas, then exports are likely to be high, and if exports are high, firms are likely to invest more for similar reasons as we saw in number 4, to support those higher levels of exports, and also because they are more confident in their future viability, I suppose, of the business. Last couple then, quite quickly, this next one. We saw in item 1 that the interest rate and the cost of finance is an important factor. The ability to access finance is also important, and this was a major issue during the financial crisis back in 2008-9. Because businesses just couldn't borrow. The banks just simply were unwilling to take risks on businesses. And so although the interest rates at that point had been brought down to quite low levels, firms were actually finding it very hard to access the finance that they needed. And finally, the government has a role to play. And there are kind of two main ways, I suppose, that the government can influence the levels of investment within the economy. The first one is through taxation and subsidy. So the government could alter either the overall level of tax on business, what we call corporation tax. That will link back up to number 2 here, because it will enable the businesses to keep more of their profits. Alternatively, the government may decide that they are going to subsidise some form of investment activity, which would make it cheaper, and so would increase the incentive for firms to invest. The other aspect is regulation, and regulation means laws, essentially. So the government can impose laws or can change laws and so on in order to try and make the investment environment more comfortable for firms. And that's another role that they can play. So let's just zoom this out just a little bit so we can try and get it all on the same screen. So there we go. Those are the 7, although as we've said, they are very, very interconnected. Those are the 7 elements that you need to be aware of in terms of the factors which will affect the level of investment within the economy.